South Korea's financial regulator toughening regulations on single-stock leveraged exchange-traded funds. New ETFs linked to Samsung Electronics and SK Hynix have been temporarily banned in an effort to protect retail investors amid sharp swings in the market. Now, from early August, the minimum account balance required to trade leveraged ETFs will triple to 30 million won, or about $20,300, while the minimum trading unit would be raised to 20 shares from 1. Retail investors also face additional training to deal in such instruments. The new measures mark a sharp pivot, given the single-stock leveraged ETFs were only allowed in late May. A surge in the popularity of these leveraged ETFs tied to the two chip makers has been blamed for the jump in volatility in the broader market. And for more insight, we're joined by Patrick MUNnelly, who is a partner for market strategy at Tickmill Group, and he's speaking from London. Patrick, welcome to the show. Now, the regulator is moving to curb these single-stock leveraged ETFs. Why have these products become such a concern?
Well, they've become such a concern, good evening, Angela, because the regulator wants to keep or maintain the attractiveness of investment whilst reducing the allure of fast profits and get-rich-quick schemes by the leverage offered through the ETF products. Essentially, what happens is an investor can put a small down payment in place and trade on extreme margin, and that exacerbates swings in volatility because the investor can suddenly realize that their exposure to the market is far greater than they originally conceived.
Yeah, so people might say these are quite niche products here. So why are they driving such big swings in the Kospi?
Well, they're driving such big swings in the Kospi because they're essentially tied to underlying stocks that have to be rebalanced daily. So these exchange-traded funds essentially are offering exposure on leverage to the likes of Samsung and SK Hynix, which are the prevailing counterparties essentially that are being covered through these exchange products. And so on a daily basis, they have to be rebalanced. And so when traders, small lot traders, are making impulsive and emotional moves throughout the trading day, that causes additional rebalancing, which causes a feedback loop of volatility as the products have to be rebalanced to match the exposure to the underlying stocks.
Right, and speaking of Samsung and SK Hynix, they now account for more than half of the Kospi. Has concentration now become the market's biggest vulnerability? And what risk does that create?
Concentration risk is a prevailing problem, not just for the Kospi, across in the US as well. The same issues are in play there with the allure of AI investing. And that's why it's so incredibly important that investors are educated, not just in the upside that can be attained through smart investing, but also the potential downside that can be experienced through volatility. And certainly that's something we focus on at Tickmill, is keeping investors engaged and educated in both sides of the coin.
So do these new measures then strike the right balance, or could they actually trigger even more volatility before they start taking effect?
So certainly they're initially hoping that this will set the tone now for more conservative investment style approach to these products and reduce the gambling type style investing that has been highlighted of late. And so what they're looking to do is calm the markets and dampen volatility. That will only come to bear over the coming sessions and watching market activity and volumes to see if the intended consequences do actually come to pass.
And could these rules widen the gap between Seoul-listed chip stocks, for example, like SK Hynix, and also their overseas listings?
It could potentially have that impact, but essentially they're looking to, by dampening the volatility caused by the ETFs, they're looking to maintain reasonable parameters within that trade.
And what should investors then be watching over the coming weeks to tell whether or not the market is stabilizing or whether there could be more downside ahead?
Certainly. I mean, from an index level, as the market has pulled back towards the 6,000 level, I'm talking about the Kospi here, obviously that's going to be a key psychological level to keep an eye on. As long as prices remain above there, then investors will feel relatively safe within the environment, especially with the new rules being implemented. But an age-old adage comes into play. In times of volatility, the focus for investors often becomes return of your capital as opposed to return on your capital. And that's something we at Tickmill definitely focus on.
And from your view, do these measures seem like enough, or do you think we're quite likely to see regulators step in again if the volatility persists?
Certainly, if the volatility persists, and like I say, that 6,000 psychological level in the Kospi will be key. As long as we maintain that and trade above there, then I think, although it has been a very volatile pullback, I think a calming effect in the market now and trading above that 6,000 level, I think will relieve investor concern and certainly relieve the anxiety of the regulators as well.
Patrick, thank you so much for your insights. That was Patrick MUNnelly, who is a partner for market strategy at Tickmill Group in London.